Hey, good morning, everyone. Marty Missouri here, 9/20/2021, Monday, back from vacation. This is going to be your morning note this morning with the big sell-off in stocks. Dow's down over 500 points as I speak. S&P's down over 1.5%. Nasdaq's down 1 2/3%, and the Russell 2000 is down about 2%. Our core allocation, by the way, is down about 1.4%. So with that in mind, folks, remember that we're hedging against the big double-digit declines like we had last February, March, not the low to mid, even high single-digit declines, although ultimately as we push into that double-digit range, which we will ultimately, I'm not saying we will now, that's where the type of hedging we're doing becomes meaningful. Other than that, through the diversification, like for example, gold is our third biggest position, and it's actually up 1/3% today. So that helps out as well. But what's really bringing us down to where the US market is our non-US exposure. Asia Pacific's getting walloped. Europe's taking a hit as well, more so even than the US market. Now, I want to, with that in mind, I want to jump over to this chart, which I've been showing you a lot. And this is the US market versus those positions that we have, Asia Pacific, emerging markets, Eurozone, and then of course this is gold and ag commodities. This is the trajectory from the bottom of the last bear market, or the great financial crisis, 2007 to 2000, early 2009, to current. And we've had this just exponential growth in the US market, just huge coming out of last year's 35% 3-week decline. We talked a lot about that and what we believe is behind that. But we have, on a relative basis, huge underperformance in areas that offer better value, pay higher dividends, do well in a weak dollar environment, which we think is critical to the system not blowing up in the years to come. So again, we really like where we're positioned, but on a short-term basis, we're going to see a lot of volatility. And for extended periods of time, if you're just comparing to the US market in this environment, obviously there's some underperformance there. So anyway, my point is that we do see opportunities from a global macro standpoint that we're going to continue to take advantage of. And we do see a lot of risk here in the US market, which we are hedging against a major downside. So as you can imagine, there's no upside unless there's downside. So we have to accept some volatility to achieve, above inflation rates of return over the long term, which is what we're after. In terms of what's going on this morning, we have the news out of China, and it's just an ongoing ugly story about Evergrande, which is an absolute monster in the property space. And China has a property bubble that they've been concerned about. They've been trying to let the air out of that bubble. Evergrande has $300 billion in debt, and they've warned debt holders that they may not be able to make interest payments, that they may default going forward. The Chinese government, Chinese central bank, has stepped in with some monetary easing off and on over the last few weeks, particularly as Evergrande has threatened to kind of blow up all over the place. Well, it's happening as we speak. Chinese markets are on holiday until Wednesday, and that eerie silence is really doing a number on global sentiment this morning. Plus, you have the Federal Reserve and 12 other central banks, frankly, meeting this week. But the Federal Reserve on Wednesday is a biggie as well, and that no doubt has market participants nervous because the anticipation is that the Fed will announce that it will begin tapering its bond purchases by the end of this year and maybe give us a timeline in terms of when they go to zero. And then the fear is after that, then the next move is to hike interest rates. Well, as we know, the U.S. central bank is exceedingly stock market centric. So we'll see. I suspect if this continues into the week that Fed Chair Powell will do his darndest to issue a market-friendly statement. And we'll see if the dip buyers are ready to jump in on that. And of course, they could jump in today, for that matter. Folks, what we're experiencing is market dynamics. And as I mentioned here recently, seasonality. September is the only month of the year that has a long-term negative average return. And as I said in that blog post, August and September are typically the two worst months of the year. So we're feeling that for sure. And clients, as it relates to your allocation, it hasn't been a stellar year relative to the US market. We've had pockets of huge growth. But all in all, we've kind of been doing what we set out to do, and that's compound returns at a decent rate and mitigate against huge downside risk. So that's what we continue to do. Although I must say that we do feel very good about the upside in many of these positions, as I just showed you, that have been underappreciated for years now. And political regimes are changing in Germany, which ultimately probably looks to be very market friendly for the Eurozone, and in Japan as well. Same story in terms of market friendliness. So yes, we will see downside risk from time to time. Last September, after the February to March debacle, we had a 10% correction, and we had almost a 9% correction in October. So right now, given the overall macro backdrop, our assessment is that recessionary conditions are not high like they were in the late summer of 2019. But we are seeing what I'll call here a macro slowdown, and that's, exacerbating things a bit as well, but not recessionary conditions, not at this juncture. Typically, the big, bad, destructive bear markets happen during recessions. And again, we're hedging away a lot of that huge downside risk as well. And we're going to continue to do that while this market looks as toppy as it is. So lastly, since I have this chart up, this is that S&P 500 chart that we look at. We've had this upward sloping wedge with these bearish divergences for a long, long time. They're never sell signals until you break through the wedge and through the 50-day moving average. We've got that today. So we'll see if this doesn't spark something bigger to the downside, and then we don't get that September double-digit correction like we had last year. Time will tell. Lot can happen. China can step in and verbally really turn the tide by offering support to the Evergrande situation. Don't be the least bit surprised if indeed that happens within the next hours, days or weeks. So folks, a lot playing out here, and at the same time, seasonality playing out here. I'll leave it there. Thank you as always for watching and listening. Of course, I'll be back very soon. Take care. Bye-bye.